Well, how are you doing today? Today, we're going to be discussing opportunities in stock splits and IPOs. So, first of all, I'm going to start off by talking about Chipotle. This one gapped up a little bit over a week ago after announcing that they were going to be doing a 50-to-1 split. So, when you look at the stock and you hear that news, well, what does that mean and what can we do with it? Well, first of all, I'm very excited about stock split news for a couple different reasons. I mean, number one, Chipotle, it used to be a great stock to trade. I mean, it used to be something that I traded all the time. I mean, especially if you look at the trends that this stock had throughout 2016, 2017, 2018, even into 2021. I mean, the trend was phenomenal and I traded it a lot back then. But what happened over the course of the past couple of years was just that it's gotten so expensive. And what that means is that, obviously the stock price is expensive, but the options are really expensive as well. And with it being such a high price name, it also means that the spreads on the options are generally pretty wide. And so for me, I like trading a lot of butterflies. I like trading a lot of spreads. And when you have a stock and you look at the money call in a monthly series, which I mean should be one of the most liquid options contracts to look at, and you can see that the bid and the ask are going between 58.40 and 62.60. The spread on that is just going to be way too wide to create any kind of butterfly spread or debit spread or anything like that, because I mean there's just, number one, no liquidity, but because there's no liquidity, there's a wide spread, and you're never going to have an edge creating a butterfly in a stock like this, because, if the entry point is going to range from, let's say, for example, $3 to $7, okay, you can pay anywhere in that range. That means some people, when they're getting filled up on the high end of the range, and some people, when they're getting filled, they're getting filled on the low end of the range. But what that means is when you're trying to get out, there's also a massively wide range. And so, let's say when you got in, you got filled at the highest end of the range, so you paid a lot of money. And then when you're trying to get out, you have the same problem. You have this massive spread. And so what that means is that generally, when you're trying to get out, you most likely can't sell it for the top price. And in order to get filled, a lot of the time you have to sell it for much lower price. And so just because of the spread, you are in this situation where you don't have an edge trading this ticker using options. So what I'm most excited about is the fact that when this thing splits, hopefully it'll get a lot more volume in it. It used to be a really good ticker to trade. It used to have a lot of volume when it was the lower price name. Um, and I think we'll be able to trade it. So when you're looking at your options chain and you're trying to determine if there's enough volume, the first thing you can do is just go to the monthly series, um, and just start by looking at the money strikes. So you're trading at 29.31, so look at 29.30. You should see several hundred contracts of volume and open interest in an at the money strike during a monthly expiration series. When you have columns that say NA, and there's 5 contracts here, 14, 4, there's just no liquidity. So if we look at that and compare it to, let's say, Microsoft, which of course is highly liquid in the options market, and if you look at the at the money strike in the monthly series, you're going to see that you have 10,000 contracts here, and thousands and thousands of contracts here. So if you ever wonder, like, why is she trading the same stocks over and over again, it's because they have liquidity in the options market. So with Microsoft and the Magnificent Sevens, I mean, the other great thing about them is they have liquidity in the weekly series as well. So you can trade them all the time, which is why I do that. But the moral of the story with Chipotle is we're going to be able to trade it more because of the split, because it'll probably have more liquidity, probably have more action. I mean, this is a great stock, great company. It's been a really strong trend. I'm, I'm considering buying maybe like 2 shares for one of my long-term stock accounts because I'm working on building up positions of 100 lots so that I can sell covered calls. And, with Chipotle, um, it has earnings coming up. It also has a split coming up. I actually don't have that on my here. Let's see if I can get a little bit more data. Add that on there. Maybe the thinkorswim bubble's just not on there yet. Um, let's see, June 26th. So let's just add a little bit more data. See if that's enough. Okay. So you have the split that's coming up on the 26th. And so I mean, okay, here's the thing. I don't I'm not in the habit of buying shares of stock when a stock is at a new all-time high. That's pretty much never going to be the moment where you want to buy shares of stock. Generally, if I'm buying shares of stock, I'm going to be doing it when there's a weekly squeeze. So, for example, with Nvidia, you had this big upwards move and then you had all this consolidation. You had weekly squeeze. That was the time to buy it, right? This was another time I was buying it down in here when we had this weekly squeeze before that consolidation breakout. Um, I did hold it all throughout this downdraft, which was not very pleasant, but it bottomed out at the 200 simple, so it worked out fine. Um, but when you look at Chipotle and you say, okay, well, can I buy the shares of stock right here? I mean, I might do it in my kids' account, just because it's like a long-term account. I still haven't decided, because like I said, I do want to be building up share positions. And here's the thing about the split is that this is something that can cause a continued rally going into the split and then also after the split. So you might look at it and say, well, it's at new all-time highs. Like, how could you possibly make money there? Um, well, if you look at your targets that it's already made, it's already made the 1272, it's already made the 1618. Your next target's going to be up here at 3250. And if you look at something like Nvidia, which by the way, that was one of my favorite trades in Nvidia was trading it into the split. Um, if you look at Nvidia into the split, I remember specifically people saying around that time frame, like, "Oh, this thing has gone way too far, too fast, and like there's no way that it can keep going higher." And I understand Nvidia and Chipotle are very different, right? But I'm just saying that when you have a split, when you have a strong stock that's been in a really nice trend, it's very common that you see this major rally going into the split. And then it's even more common that you see the rally after the split as well. So I do think that there can still be more upside in this. Um, because if you look at, and there's a bunch of different examples over time, we could go back and look at the Apple split, but we had this split in Apple that was in 2020. Obviously, market condition was a little bit different in 2022, but I mean, it always is, right? So if you look at the split, you just had this phenomenal rally going into the split, had this huge rally even like after the split. Yeah, it did pull back, but then it based out and it broke higher again. So if you go back and you say, all right, well, do you remember when we were talking about buying Apple ahead of the split? Where was it trading then compared to where it's trading now? I mean, still a great entry point. Another one that I want to bring up is Walmart because this is one that I was looking at as well for trading it into the split. And even when I started making videos on this, I I was like, man, it'll It'll be crazy if Walmart does similarly to what some of these others have done because it's Walmart, right? It's not Nvidia, it's Walmart. But Walmart announced the split, and you still had just this huge move going into the split, and you still had a huge move after the split. So, um, the moral of the story is that, of course, you need to understand that the split doesn't it doesn't change the underlying fundamentals, of course. Like, we know that. And that's what people always write on any video that I make about buying a stock ahead of a split. Like, "Oh, it doesn't change the fundamentals." I'm like, "Yes, I'm fully aware of that, but I don't care because if you're looking at a stock that already has a really positive trend and already, they're doing very well over their earnings reports, um, and that it's very common that regardless of the fact that it doesn't change the fundamentals, people still come in and buy it both before and after the split. It gives you a trade setup. So that's what I care about the most is I care about the trade setup. With Chipotle in particular, it is a little more challenging because as I already covered with the options market, it's pretty much impossible to trade this in the options market because of the liquidity. So if this was another stock, the first thing I'd do with it is I'd place a butterfly up at my overhead price target, and I would try to trade it both going into the split and then after the split. But you can't really do that with this name. So that's why with this one, I think your only option is buying shares. Now, is it crazy to buy them this close to a previous all-time high? I mean, sure, but if you look at your potential upside target, and in Chipotle, that is going to take us to go into July, let's say. You still have $365 of an expected move in Chipotle into that time frame. So if you're looking at that and you're saying, well, obviously it's not going to go directly up $365. It's a range, but I mean, how is that for upside? It's pretty decent upside. So I would target up into 3,200. I think that's the key psychological value. I think that's a nice overhead price target. I think getting in at 2,930 is just fine. If you could get in lower around 2,800, I think that would be fine as well. Probably be a little bit better just because you'd have more of an upside range and more of an edge. But that being said, if it does break down to that level, then you are losing a little bit of momentum. So with these trades, it's typically better to just ride the momentum, even though you're getting a little bit more of an aggressive entry. So I think with this one, I'm just going to buy the shares. Buy the shares with the idea that, you can sell covered calls on it. I don't know, build up your long-term share positions, and that's kind of what I'm working on in my long-term accounts. So that is what I have with Chipotle. Be on the lookout for any other stock split when you're looking at stock splits. I think that they're like one of the best opportunities, and I really hope we get a good split in something like Microsoft. That would be great. Love Microsoft. So I think that'd be a lot of fun to trade there, but that's just wishful thinking at this point. So, what about IPOs? This is another question that I get pretty frequently. How do you trade an IPO? And it's very common that traders will want to come in and buy the stock the day of the IPO. You can do that if you want. In this case, it would have been okay to do that because it actually went higher before it went lower, which is very uncommon, by the way. Um, but it's generally almost always better to wait until the first hype wanes because you're generally going to have um, hype at the beginning. It's in the media and everybody's talking about it and want to know when are you going to buy it, and then it gaps up 40% the first day, and everybody's got FOMO and they've got to have it. And those people buy within like the first day or two. And then generally what happens is it kind of rolls over and everybody kind of forgets about it, consolidates, and then it gets ready for the breakout if it's going to do that. So for something like Reddit, generally, if you can get about 3 weeks of trade in it, that's going to be the point where you're going to have a little bit more opportunity um, to identify an overall technical pattern. Because right now, when you only have a week or so of trade, you're just you're not going to have too much of a technical pattern where you can apply technical analysis. If you look at a lower time frame chart, you're going to have a little bit more data. Um, but I mean, you can see that it's pretty much already back to the starting price. So you don't want to be that guy that came in and bought it like when it was at 75. Um, and now, you know, you're already down big because you bought it within the first week. So there are some times where the IPO will just keep going. But even with something like ARM, I mean, you can point to ARM and you can say, well, what if you would have bought it the first day of the IPO? Obviously, right now you'd be making money, but would you have hold it? Would you have held it is the question. You buy it right here, and then for weeks, you're just down, you're down, you're down, you're down, you're down, you're down, you're down. They report earnings, you're still down. Okay, now it finally starts shifting higher. So if you're, going to be a diehard and you're going to buy it and you're just not going to care what it does and you're not going to take a stop and you allocated your risk position and you're not going to change it, that's one thing. But if you're going to buy it and then it starts trading lower and you bail on it at the lows before it rallies, that's no fun. So that's why I generally say it's better to just give it a couple weeks and then it'll start shifting. And earnings is really when these things come into focus, because with a new IPO, everybody wants to know what they did over earnings. And so that's the opportunity and that's a catalyst where this thing can really get going. So I do like being involved in those before earnings reports. Um, Here's another example. When you look at this one here, this is another one that was talked about quite a bit last year. And so this is Instacart. So when it first IPO'd, it was a big day, like, oh, everybody's ordering groceries online. And then it just, for weeks, months, it traded lower, traded lower, traded lower. Stock prices cut in half. And then finally it shifts. It turns around the other direction. We get some high volume. We have an earnings report that did well, and off it goes. So one could argue, if you got in at the IPO date, you'd be back to break even. That's true if you actually held it. But a lot of the time, what will happen is people get into the IPO and then they say, oh my gosh, I'm losing money. I'm losing money. I'm losing money. This is a terrible idea. Why would I do this? Okay, dead lows. I'm going to sell it. And then that's exactly when it turns around. So that's just what you want to be careful with that. With my long-term stock account, what I do is I basically just dollar cost average into stocks that I want. So, you can deploy that strategy when something is trading lower. It's trading lower and it's consolidating, especially, there's a lot of IPOs that people come up with in the trading room. They'll ask me about them. And my IPO advice is generally the same, but what differs is obviously going to be the company. So there's going to be times where it's like, oh, that's a really cool idea. I could stand behind that idea, like that business. I use that product, whatever the case may be. And if it's more a function of you feeling strongly about the product and using it and liking the company and, you think they're going to be the next best thing, there is no problem with, I have no problem with you just buying it because you want it. There's really nothing wrong with that. Just keep in mind the regular trends, the regular patterns, and with an IPO, the most important thing is to pay attention to earnings because you're going to want to see how they're doing because that is what's going to make all of the difference. When you have IPOs that they just never end up making money, like those are the ones that are just completely hosed. So, you can have a good idea, but if you're and I think Teladoc is like a great example, even though it wasn't I understand it wasn't a more recent IPO, but I think this is a similar chart pattern to what a lot of IPOs can look like. Um, they come out, it's like, "Oh, I know they're losing money." And you can see on this Teladoc chart every single quarter, losing money, losing money, losing money, losing money, losing money, losing money. And yet people are still buying it because they think, "Oh, it's going to be the next greatest thing." But what happens is if they can't figure out how to stop losing money, all of that hype is going to wear off and it's just going to implode. So that's why I tell you, if you're buying an IPO because you think it's going to be the next big thing, that's fine. You know, there's random names people come up with all the time that I've never heard of that I always want to do research on them before I'm going to comment intelligently on them. But I will tell you the most important factor is going to be earnings. So it doesn't matter how much you like something. If the company can't figure out how to make money, it's going to be a teledoc, which is not something that you want. So that's why you got to pay attention to the fundamentals. I think Peloton is another pretty good example of that too, because, pandemic, Peloton, everyone was like, oh, this is so great. And what was wrong with it? They kept losing money. So that's a really important differentiator. I do think that, ARM for that reason is significantly different. So, you have a company that did really well on their last earnings report, especially for a recent IPO and the earnings report before that. So that is something that sets it apart, makes it unique. And at this point, you can trade ARM. You've got options in it, you've got a daily squeeze, there's plenty of liquidity. You have an overhead price target at 160. This is something that can be traded now. Trying to trade Reddit is going to be pretty challenging because you don't have an overall pattern. You do have high implied volatility in the options market, but because you don't have a pattern, it makes it really difficult to determine which direction you're going. So if you want to trade options in Reddit just because you love it, you feel so confident about it, and you just know it's going one direction or another, um, you can come in and you can sell spreads. If you think it's going down, you can sell a call credit spread. If you think it's going up, you can sell a put credit spread. The other thing that you can do is if you want the shares and your account can withstand it, you can sell the naked puts. Do not do that if you don't know what you're doing. But one way that you can pick up shares of stock if you want it is you can come in and say, I want to collect $4.30 credit for selling the $50 strike. And you know what? If it goes below $50 and I get assigned, then I'm going to own those shares and I'm going to be happy about it. And I'm going to appreciate that I took in some credit and I'm going to own my shares of Reddit. So that's something you can do with it. That's something that I used to do on DWAC. Now it's DJT, but these tickers like this that have a lot of high implied volatility, they're recent IPOs. They have a lot of hype around them. The options are really, really expensive. And when you have really expensive options, the best thing to do is sell them. So same thing with DJT. You can come in and You can sell um, puts that are outside of the expected move even, but, they're not gonna have as much value. If you have an expected move of $15, um, you have a put right here that you could sell for $1.33. It's not a lot, but is it likely to become in the money? It's right on the range of the expected move. If you really want the shares and you wanna take in a lot of premium, you can sell them right here at the 55 strike, take in $5 of credit, and if the stock falls below that zone and you get assigned, you have your shares at 55. So those are some option strategies that you can use with Chipotle, with Reddit, with IPOs, and with splits. There's definitely a lot of different things you can do with them. These are going to be some of the more volatile names to trade, but just keep in mind because they're volatile, they have a lot of implied volatility. And when you have really high implied volatility, you have juicy options that you can sell. So if that's something that you're into, that is a strategy that you can use. If you have any questions, definitely let me know. You can follow me on YouTube right here at Trader Danielle. Make sure you don't follow any of my scammers because there's a lot of people that pretend to be me, but this is my real channel right here. So you can join me right there and learn more about me and my trades. Other than that, I hope you have a great rest of your day, and I will see you next time.